The debt's not going up at 2% or 3%. The debt's going up 8, 9, 10% or more. The U.S. had a $1 trillion baseline budget deficit, $1 trillion per year deficit for fiscal 2020 pre-pandemic. The Congress threw $3 trillion of emergency aid on top of that. And I'm not even criticizing all those programs. I mean, the payroll protection plan loans, the extended unemployment benefits, the increased unemployment benefits. Imagine where we'd be if we hadn't done that. But that aside, debt is debt. They piled $3 trillion on top. Now, this is going to take the U.S. debt to GDP ratio up to 135%. It was 106% when Donald Trump was sworn in. It's close to 130% today. Because remember, you got two things going on. It's a debt to GDP. So debt's your numerator and GDP is your denominator, right? Well, what happened? Well, the denominator shrank. This got smaller and this got bigger. So what happens to the ratio? It blows up. So now it's 135%. If you get the laws of economics right, which is not easy because most economists don't, but if you get them right, it's really a reflection of human nature. I mean, what is an economy other than all the people in the economy starting businesses, buying, selling, traveling, providing goods and services, et cetera. So human nature doesn't change, or at least it hasn't changed much in the last 100,000 years. So the fundamental laws of economics don't change either, but circumstances change, facts change, and that's important. Now, to answer your question, Kerry, you're right. There is a school of thought, a growing one, an influential one, that the debt doesn't matter. It's like, well, wait a second. So what? So the debt to GDP ratio went to 135%, which it did. Who cares? Well, what's wrong with it? 180%. We got issues. We got problems. Print up the money and monetize the debt and spend it and keep going. What is the problem? This comes under the banner of something called modern monetary theory, MMT. It's flawed, it's wrong, but it's got its followers, and those followers are now in the White House because one of the things Joe Biden had to do to get elected was to make peace with the Bernie Sanders wing of the Democratic Party. They take the view that if the Treasury didn't spend the money, how would anybody make any money? That's ridiculous, but that's what they say. They say, hey, when the Treasury spends money, what do? Well, they build aircraft. They have benefit programs. They have government contracts. They do whatever they do. But when the Treasury gives you the money, you take the money and you spend it on somebody else, goods and services, go out to dinner, have subcontractors, whatever it might be. That's the real source of money. They also take the Treasury and the Fed and they merge them. Now, that's not legally the case. The Treasury and the Fed are separate institutions. The Treasury is just part of the executive branch, and the Fed is an independent agency. And the Federal Reserve banks are actually privately owned. A lot of people know. Some people know that, some people don't. But the Federal Reserve banks are privately owned by banks in the districts, so Citibank, Bank of America, et cetera. So they're completely separate. But the theorists ignore that and say, no, the Treasury needs to spend money because that's how the economy grows, and the Fed can monetize the debt. So you spend the money you don't have, you borrow to cover it. You issue bonds to cover the borrowing. And if the market wants to buy the bonds, fine. But if not, the Fed can buy them and put them away on the balance sheet, wait 30 years and collect the money. What's the problem? Who cares about the debt to GDP ratio? It's kind of a statistical abstract, but why should that stand in the way of using money to solve our problems, which are free healthcare, free childcare, free tuition, forgiveness of student loans. That's a $1.6 trillion ticket, by the way. And look, everyday readers and investors, there's no reason they should know all this stuff. This is total inside baseball. You have to be a geek like me to kind of keep up with it, but it's all coming. But what that means is we're going to test the Rogoff-Reinhardt thesis. Now, let me just take a minute to explain that. Up to a certain debt to GDP ratio, there is a Keynesian multiplier greater than 1. So the classic example is the UK was in a depression before the rest of the world. They have been hit pretty hard before the Wall Street crash. People aren't spending, they're saving. It's the liquidity trap. So if you get money, you pay down debt. When you don't have any debt, you put it in the bank. Whatever you do, you don't spend it. You hoard cash. Or people were buying gold. They were accused of hoarding gold, etc. But what they weren't doing was spending. And there was a lack of aggregate demand, and the banks were not lending. So Keynes said, well, if everyday people won't do it, the government must. The government can borrow. The government can spend. And what they discovered was that if you borrow $1 and spend $1, you can get $1.50 of GDP. Now, there's a separate debate as to whether that's actually incremental or whether you're just pulling growth forward. But so what? Even if you are pulling growth forward, maybe that's what you need to do when you're in a liquidity trap. But there's a problem. He called it the general theory of employment, interest, and money. But it was actually a special theory. I think he had a little Einstein on me because of the general theory of relativity. But it's actually a special theory, which means it's a theory that works in a set of circumstances, a set of conditions. The conditions where it works are you're either in a recession or just coming out of one. You have excess capacity and labor and industrial capacity, and you have very little debt. In those circumstances, you can borrow $1, spend $1, and get more than $1 GDP. The problem is that extra GDP you get for the borrow and spend, it goes down as the debt to GDP ratio goes up. What Reinhardt and Rogoff discovered is that at 90%, you go through the looking glass. Your payoff is now less than $1. You borrow $1, you spend $1, and you only get 90 cents of GDP or 95 cents, et cetera. So now, not only are you not getting your dollar's worth for the borrowed dollar or something more, which you did at lower levels, you're getting less than $1. So now what's happening? You're borrowing $1, you're spending $1, you're not getting $1 of GDP, but you are getting $1 of debt, which means your debt to GDP ratio is going up and the 90% is getting worse. And I just mentioned the United States is at 135%. So here are your two competing schools. There's the Keynesian multiplier and creating aggregate demand with government debt, and the Reinhardt-Rogoff, more than a thesis, I would say powerful evidence that beyond 90%, it doesn't work. It goes under less than one, on the one hand. And my friend Stephanie Kelton and Bernie Sanders and Kamala Harris and the modern monetary theorists who say, no, it's all good. How could you get growth if you didn't spend money through the government? These theories don't agree at all. We're going to find out which ones work. I'll give away the answer, which is that Reinhardt and Rogoff have it right. Keynes had it right up to a point. Reinhardt and Rogoff discovered that critical threshold, that whether you want to call it tipping point or phase transition, or which physicists call it or whatever. The modern monetary theorists think the opposite, and we're going to find out. But what it means if Reinhardt and Rogoff are right, and I'm right, and Keynes was right, the more you borrow, it's actually a headwind to growth. Now you get just as up to the threshold, you got more and more and more. Oh, sorry, at a low level, you got more, but then it went down. But it's like any diminishing marginal return. You know, the curve starts very steeply, you get a lot of payoff, then it flattens out, then it goes down, but it's still positive. But at some point, it goes below the zero line and your marginal return is negative. And that's where we are. People say America has never defaulted on its debt. Well, first of all, that's not true. It's not a true statement. But the easiest, quietest, stealthiest way to default is inflation. It's like, hey, here's your $1 billion back. You know, good luck buying a loaf of bread because I've destroyed the value of the dollar. And so now 3%, we'll do it in, do the math, we'll do that in about 22 years. At 10%, you cut the value of the dollar in half in 7 years. By the way, that is what happened between 1977 and 1981. In that 5-year period, the dollar lost over 50% of its purchasing power.
According to Jim Rickards, hyperinflation is coming to America, and the raising of interest rates won't be able to help fight inflation. In fact, it will make inflation even worse. Inflation will impact stock market as Jim Rickards think it will brings the economy into recession, and unemployment will go up to 4 or maybe even 5%. But all Jerome Powell can say is, too bad, that's painful and we have to get there, but we're gonna pay higher prices if we don't. And then there's the myth of 2% inflation. The Federal Reserve have something called inflation targeting, where if they fail to have at least 2% inflation per year, then it means the economy is going into deflation, or to put it simply, the economy is slowing down and therefore unemployment is going to go up and the economy will go into recession. In order to prevent that from happening, the Federal Reserve have to target the inflation to at least 2% per year in order to bring price stability to the market and to keep the economic wheel running smooth. At least that's the theory, but to Jim Rickards it doesn't make any sense. The Fed have raised interest rates way too high, but the inflation is not going down yet. In fact, inflation goes way up even higher than before. People said between 1913 and 2023, the dollar has lost 95% of its value, but we don't need to wait for another 110 years. Jim Rickards explains that in the 1980s, the dollar loses half of its value in just 5 years. Will it do that again? Will the economy goes into recession? Let's find out.
A lot of people like to bang the table and say, since the creation of the Fed in 1913, the dollar has lost 95% of its purchasing power. Well, that's a true statement, but you don't need 110 years. We lost 50% in 5 years between 1977 and 1982. So inflation is insidious. It is a tax. It is a form of theft. But like the kid with the mother's wallet, if you keep the theft in small little bites, but do it long enough, you can get the whole thing and no one will notice. So they say we want 2% because we want to be able to cut if we have to. But the real reason is we want to basically erode the value of the debt and erode the purchasing power of the dollar in ways that you don't notice. And they can be very patient. That's how they do it. But to your point, Addison, well, hasn't the Fed been raising interest rates? Yes, but real rates are still negative. So if inflation's 9 and the Fed's at 2, the real rate is -7. That's a really, really low interest rate. And if you say, okay, inflation's come down to 6 and the Fed's up to 4, about 4.5 right now. So the real rate is now -1.5 in my example. Well, that's a lot less than 7, but still a negative real rate. We are not in the world of positive real rates. So then the question is, okay, how is the Fed doing at getting inflation to the target, the 2% we talked about, and explain why that's their number. And this says a lot about what's going on in the stock market right now, because you go all the way back to August 26, 2022. That was Jay Powell's Jackson Hole speech. And he said, inflation's, he didn't use the word out of control, but he said inflation's way too high. We're going to bring it down to our 2% target. We know unemployment's going to go up. We know he will probably have recession. He did not use the R word. He didn't say recession, but he said, growth will suffer, unemployment will go up. That's just a fancy way of saying there's going to be a recession. And we're not going to stop until we get there. And so in other words, too bad, unemployment's going to go up to some number, I don't know what, 4 or 5%, which is pretty high. It's right now it's 3.4, I believe, the lowest since 1969. So unemployment's going to go up. The economy's going to go into recession, but too bad. That's the price we all have to pay to get inflation down under control. And the way to 2%, in other words, and the way Jay Powell rationalizes this, he said, yeah, that's painful, and we're going to pay a high price to get there, but we're going to pay a higher price if we don't. If we don't get to 2%, and we let this thing spiral out of control or even stay at 4 or 5% for a prolonged period of time, that the economic damage from that in terms of lost investment, misallocation of capital, basically people losing money on their investments, is going to be much higher than maybe a short recession.
Here's the interesting part. Jerome Powell scares the market with 6 speeches. He said the same thing again and again. We need to get to 2% inflation, which means raising the interest rates even more, and therefore we're going to have a recession and unemployment is going to go up. With the Fed being hawkish, the market should go down. Instead, the market got rallied because they believe inflation is going to go down soon. Jim Rickards thinks the Fed is already reached at something called the terminal rate, a rate which inflation will go down on its own, so the Fed won't need to raise the interest rates any further. But the Fed keeps raising it and making the economy crash even further. So how is it going to end? When will the Fed needs to stop raising interest rates? Let's listen to what Jim Rickards have to say.
So he says that the market didn't believe him. The market rallied. Went down a little bit right around that time, but then the market rallied in October. And he comes out at the end of September, gives another speech at an FOMC meeting, comes out November 2nd, gives another speech, comes out November 30th, gives her a speech at the Brookings Institution, then comes out in mid-December with another speech, and then again a couple of weeks ago on February 1st. So it's like 6 speeches in about 5 months. And he said the same thing every time. He said, we're getting to 2%. Believe me when I said we're going to have a recession. Unemployment's going to go up. Too bad. We have a lot of work to do. We're not done. The market has flipped on and off. Half the time the market doesn't believe me. Go, yeah, you say that. But in fact, inflation is coming down faster than you thought. You're probably, I should introduce a concept. I guess a lot of people have heard of it, but there's this new concept called the terminal rate. The Fed's trying to get to the terminal rate. And so what's the terminal rate? Well, no one actually knows what the number is. I don't know, but neither does Jay Powell. But it's a theory. And the theory is, okay, the terminal rate is a rate set by the Fed that's high enough to bring inflation down without further rate hikes. We get to a level, and that level is high enough that inflation will come down on its own just by waiting without raising the rate again. And the conundrum, I hate to use that word, but it is a conundrum. The conundrum the Fed faces right now is they have been raising rates and inflation has been coming down. Those two things are true. But is inflation coming down because they're raising rates, in which case maybe you want to keep raising them, or are you already at the terminal rate? It's coming down on its own, and now the danger is you're going to go too far. And that's the debate with Wall Street. And so Wall Street is sort of leaning to the view, now you're probably already at the terminal rate. Inflation's coming down. You need to back off. You need to stop and probably pivot. This was the famous word for the last 6 months. The pivot means you're actually going to have to cut rates because you have gone too far and you're going to cause a pretty bad recession. And so the expectation as recently as December was that the Fed would pivot around March or April. They would raise in February, maybe March, but pretty quickly after that, they would cut rates. And if the Fed's cutting rates, buy stocks. It's typical Wall Street analysis. It always ends with buy stocks, particularly tech stocks.
So, with the current high interest rates environment and reckless government spending, what should we do to protect our money from inflation? Should we buy stocks? And what stocks should we buy? The Fed said it will raise the interest rates even further, but the market thinks the opposite will happen. So who's right and wrong here? Let's hear what Jim Rickards think. Spoiler alert. This is not investment advice.
But the Fed has been saying the opposite. So there's been this battle where Powell goes 1, 2, 3, 4, 5, 6 speeches, says the same thing. We're not stopping. And Wall Street says, oh, yes, you are. So buy stocks. Well, who's right? Well, there's an old saying on Wall Street, don't fight the Fed. I don't think of it as who's right or wrong. You could have an opinion. The way I think of it is I just want to know what you're going to do. Because if I know what you're going to do, then you can trade accordingly. You can plan for that and you can prepare for it. And what they're going to do is they're going to keep raising rates. Even if they're at the terminal rate already, I think they might be. Even if they are, they don't think so. Their opinion counts for a lot more than mine. And they're going to keep going. But by the time inflation comes down enough to say, yeah, okay, we're at the terminal rate, nice job, it'll be too late. They will have gone too far because the Fed's always the last to know. Just to take a really simple example, let's say that there was, the bar of gold in front of us, and I wanted to sell it to you, and you wanted to buy it. We would go back and forth over the price. We'd agree on a price, and we'd sell that bar. But what if we had one bar of gold? And just make up, let's say a 1 ounce gold coin, so $1,400. And I said, okay, Lynette, I could sell you the 1 ounce gold coin for $1,400, but why don't I sell you 100 ounces? I only have 1 ounce sitting here, but we'll make the other 99 a paper contract. And we'll agree that either I pay you or you pay me, depending on where the price goes from here. So bear in mind, we only have 1 ounce of physical gold, but we do a deal on 100 ounces, 99 ounces of paper gold and 1 ounce of physical gold. Well, that's a much bigger deal, a lot more money involved, a lot more profit and loss for either one of us, but there's still only 1 ounce of gold. The other 99 is the derivative. So a derivative is just a paper bet. It's a paper bet based on some underlying with no limit as to how big the paper bet can be. Now, I'll give you another concrete example. And I remember in 2007, when the mortgage crisis first hit in the spring, and then there was a money market crisis, and August, and that's when Jim Cramer had his famous meltdown with Aaron Burnett on CNBC. They know nothing, but the point being, that was the beginning, and then it came to a head over a year later with Lehman Brothers in September 2018. But when it first started, there were some very smart people, and I would put, Ben Stein and others. He's an economist, and he's a comedian, actor, but also an economist. And a lot of other people said, look, there are $1 trillion of subprime mortgages, and that's about what there was with Alt-A. That's another kind of subprime, but let's say $1 trillion of subprime mortgages. In the mortgage market, 5% is a huge default rate. When default rates get to 5%, people are kind of panicking. He said, let's get crazy. Let's assume a 20% default rate. It never got that high, but just assume it. Well, 20% of 1 trillion is 200 billion. So he said, even if this thing gets totally out of control, we'll have 200 billion in losses, which was about the same in real terms as the S&L crisis in the 1980s. That was about 135 billion of losses. So adjusted for inflation, it would be $200 billion by 2007. And Stein said, well, we survived the 1980s. We can survive this. It's about the same. What he was missing was that, there were $1 trillion of mortgages, but there were $6 trillion of derivatives on the mortgages, on the same mortgages. And so 20% default rate, it wasn't 200 billion, it was 1.2 trillion of losses just to get started. And then the panic went on from there, and the losses were ultimately in the scores of trillions.
Right.
But the point being, you cannot look at bank balance sheets. You cannot look at futures contracts. You cannot look at any known quantity and understand the risk without understanding how much is off balance sheet, how much more of the same thing, the same kind of bet. And banks do not put derivatives on their balance sheet. And I've had this debate in chapter 8 of the book, chapter 8 of Aftermath. I talk about a private briefing that I had with the board of directors of Morgan Stanley and their CEO, James Gorman. And I said, well, first of all, a couple things. Number one, your derivative book might be smaller, it actually was, but that's because so many of the derivatives were moved over to the clearinghouses. They created these clearinghouses after 2008. So now, two banks do a derivative trade, and they take it and they send it to the clearinghouse, and you put it on the balance sheet of the clearinghouse. You didn't make the risk go away. You just moved it to a side pocket. So maybe Morgan Stanley or Citibank's balance sheet has fewer derivatives, but it doesn't mean there are fewer derivatives in the system. They've just been put over in the clearinghouse. Who's going to guarantee the clearinghouse? Again, Morgan Stanley's capital base may be fine, at least in most circumstances, but who's backing up the clearinghouse? Well, the answer is the members, which are the banks. So if the clearinghouse gets in distress, they're going to turn to their members and say, hey, give us capital, at a time when the banks are like, oh, we can't do that because we need all the capital we can get. So first of all, you're undercounting derivatives when you ignore the clearinghouses, number one. Number two, and this was the point I made, I said, look, as a bank, you may be stronger, but you're part of a system, and the system is more vulnerable. And if the system goes down, you go down with it. I don't care how strong your balance sheet is. You're part of something bigger, and if that collapses, you collapse too. And I said, look, you're running a bank. You can't take responsibility for the whole world. That, in theory, is the responsibility of regulators and central bankers and others. But they don't know any more about risk than Wall Street does. I mean, everyone's ignoring the risks or not computing the risk properly. So I say, maybe your bank's more sound, but you're not counting the clearinghouse, and you're ignoring systemic risk, which is bigger and more dangerous than ever. The warning signs are all over the place. You just have to understand them, incorporate them, connect the dots, and then see how it plays out. And it's not just one path, there are multiple paths, but they all sort of end up in the same place. And then I bring it full circle. I say, well, if this is coming, and it is, what are you waiting for? Why not get ready now? When I've had people say, I'll be half facetious, but it's kind of true. They say, Jim, I hear you, I agree with you, but I'm making too much money in the stock market. Could you call me at 3 o'clock the day before the crash, and I'll sell my stocks and buy some gold? And I said, well, first of all, I'm not going to know the day. I can tell you it's coming, but I don't know the day. And if I did, I'd probably be a little busy myself. But the point is, when you most want your gold, when the panic hits, and everyone like, get me out of stocks, get me out of money market funds. I want gold. You're actually not going to be able to get it. You're not going to be able to get the gold. The dealers won't talk to you if they don't already know you. The mint will be back ordered. The dealers will be back ordered. You will not be able to get people on the phone. So why wait for that? Do it now while you can.
Right. It is, because there's, you were talking earlier about people selling their stocks and their money markets and all of these and buying gold before the crisis hits. But will there be any buyers on the other side of any of these assets?
Well, that's right. And this is what I talk. That's correct. Now, this is what I talk about in chapter 4 of the book, how more and more assets under management have moved to passive investment styles.
Yes.
That means index funds and ETFs and things like that. Well, when passive investing started, when it began, I analogize it to like a mosquito lands on the back of an elephant. Well, the mosquito has a good time and the elephant doesn't even notice. So passive index funds were basically piggybacking on active investors who were committing capital, taking risk, and making markets, engaging in price discovery, and you could just kind of go along for the ride. But what happens when it's not one mosquito, it's a billion mosquitoes? The answer is the elephant dies. And that's what's happening in markets. More and more funds are going passive, fewer and fewer are going active. Well, the active investors are the ones who commit capital and make markets. So you get into a financial panic with the passive investors. Their investors want their money back, so they have to sell stocks or sell assets or sell bonds to get money to pay the redemptions. Well, where are the buyers? You've driven the active managers out of business. They're not going to be heroes like firemen rushing to a fire. They're going to walk away. And so the market's going to go no bid, and it's going to go straight down. People say, well, wait a second. How can there be a dollar shortage or a liquidity crisis when the Fed printed $9 trillion? Well, the answer is you have to understand how the money system works and where real money creation comes from. And it does not come from the Fed. And here's why. The Fed did print the money. That's real. But the way they do it, the Fed buys bonds and treasury notes from the primary dealers, from the big banks. And they call up and offer me a 10-year note. Okay, here's the price, done. Goldman Sachs will send the 10-year note to the Fed, and the Fed pays for it with money that comes out of thin air. So that is money printing. It's as simple as that. But then Goldman Sachs, in my example, takes the money and gives it back to the Fed, because the Fed's a bank. They deposit it at the Fed in the form of what they call excess reserves, and the Fed pays interest on excess reserves, so the Goldman's actually making money off it. The point is the money didn't go anywhere. The Fed did create it out of thin air, that much is true, but the recipient who sold the bonds gives it back to the Fed. It sits on the Fed's balance sheet. So the asset side, you've got all these treasury notes, but the liability side, you've got all these deposits, and it just sits there and it doesn't do anything. So where does the real money that powers the economy, if there is, if it does at all, where does that come from? It comes from the banks, because the banks can do the same thing. When the bank makes you a loan, what do? You're a business, you set up a checking account. They say, okay, here's $1 million loan. They put the $1 million in your checking account. Where'd that money come from? They just said you got the money, right? And so they have an asset, which is a loan from you with note, and they got a liability, which is your deposit. So banks create money kind of the same way the Fed does, except it's supposed to be in private commerce. And that money actually can go somewhere. If you're a business, you got a payroll, you got to buy stuff or invest stuff, et cetera. But there's not much of that going on. Velocity is very low. The turnover of money is low. But the point is that hasn't really been going anywhere. Now, but here's the key. $9 trillion on the balance sheet, maybe, $5-6 trillion today. It's a lot of money. But the notional value of derivatives off balance sheet of the banks is $1 quadrillion. And for listeners who might not have heard the word quadrillion before, 1 quadrillion is 1,000 trillion. So your 9 trillion at the Fed doesn't get you very far if you have to support $1,000 trillion worth of derivatives. And how does that work? Well, the answer is mostly the banks doing off-balance sheet swaps and swaptions and other futures and forwards, and we don't have to go down the whole litany of names, with either each other because they're trading firms, or with hedge funds who want them for speculation or hedging, or sovereign wealth funds or other institutions. There's a whole network of participants. But these are the big boys. These are the $1 trillion institutions, the BlackRock and the Temasek and the Sovereign Wealth Fund of Norway. These are the big players involved in this market. Okay, so you have $1,000 trillion of derivatives off balance sheet. By the way, you will not see this looking at a bank balance sheet. You got to read the footnotes. You got to know what you're looking at. How is that supported? Well, it's supported with collateral. Not 100%, not even close, but maybe 1%, 2%. You got to put up some margin money to be in the game, but then you can have a lot more off balance sheet. Okay, so what's the best form of collateral? Well, it depends. Whether you're in a liquidity crisis or not, whether people are feeling confident or are worried, whether they think things are going to go great or start to collapse. So as things get more difficult, and that's the phase we're in right now, the quality of the collateral has to go up. So the banks are now saying to each other, I don't want your mortgages. I don't want your stupid corporate bonds. I don't even want 10-year treasury notes. Get me bills, treasury bills. These are short-term, very liquid, 1-year maturity or less. A lot of them are 4-week bills, 8-week bills, 6-month bills. These are very short-term, very liquid. They are the best collateral there is. And the banks are saying to each other, that's what I want. Okay, so now you're Barclays Bank or Deutsche Bank or Unicredit, Credit Suisse or bank, some major Japanese bank, et cetera. Where are you going to get the bills? Well, you got to buy them from a dealer, or you can buy them at auction. The Treasury has auctions, or you can get them from the Fed. But to buy a dollar-denominated Treasury bill, you need dollars. So that's why the dollar is so strong. Everyone's like, hey, Jim, we got these huge budget deficits and $1 trillion of expenses and bailouts and handouts and, 131% debt to GDP ratio, $31 trillion in debt, et cetera. How can the dollar be so strong? Well, the answer is it has nothing to do with everything I just said. The dollar is strong because everybody in the world needs dollars to buy Treasury bills, to prop up the balance sheets of the 1 quadrillion of derivatives that nobody can see. And this is real. This is way behind the curtain, Kim. This is real inside baseball in terms of how the international monetary system actually works. So the strength of the dollar, which, by the way, is a headwind for gold, the euro's down, sterling's down, the Swiss francs are down. Gold hasn't actually gone down a lot. It hasn't gone up a lot, but it's holding its own. But a strong dollar means anything denominated in dollars is going to go down, because if the dollar gets stronger, the dollar price of the commodity gets lower, or at least doesn't go up a lot. Okay, so first of all, you got a mad scramble for dollars. Why? To buy Treasury bills. Why? Because they're the only collateral to prop up everything I just described. Now, but there's evidence of this, and again, you have to know where to look. So right now, the Fed has what they call the reverse repo program. What is that? Well, any bank, any major institution that wants Treasury bills can call the Fed and say, give me some Treasury bills. And you give the Fed cash. It can be overnight or a couple of days or whatever. The Fed pays you interest, so you're making a little money. Then they send you the Treasury bills. Well, why isn't that the solution? Why doesn't that work? Well, the answer is you can do that, and you can get those Treasury bills, but you cannot rehypothecate them. You cannot pledge them to anybody else. You have to keep them. And the Fed might want to unwind that at any time. Well, that's not good enough, because if I'm supporting some other transaction with somebody else and they're supporting another transaction through a chain of, could be 25 banks, all in the same, back to back, I want Treasury bills that I can pledge to Credit Suisse, so they can pledge to Barclays, so they can pledge to JP Morgan, et cetera. So I got to get Treasury bills either at auction from the Treasury, and they're not issuing that many because actually the budget deficit is coming down a little bit, or buy them in the secondary market. Just to put some data behind this, Robert, just to show it's not a theory. So I can, if I'm a bank, I can call up the Fed and get Treasury bills, in 15 minutes, and there's a certain price. They're going to pay me interest. I'm going to get a discount and give it back. If I buy it in the Treasury market, there's also a price. I got to, they always trade, they mature at par. So you buy them at a discount. And the difference is how much interest you make. Okay. The yield to maturity on the Treasury bill that you buy in the secondary market is lower than what the Fed will give you for free just by picking up the phone. So why would you ever buy a Treasury bill in the secondary market with a lower yield than what the Fed will hand you? Well, the answer is because you can rehypothecate it. You're desperate. You're willing to take less yield to get the one that you can pledge instead of getting a higher yield for the one you can't pledge. So it's all about the rehypothecation. But the point being, the fact that yields on secondary market purchases are lower than what the Fed will give you for free tells you how desperate people are to get those bills.
So that's causing this liquidity crisis.
That's the beginning of a liquidity crisis.
And that's what you're warning everybody about right now.
Right.
I mean, you want a lot of things.
I spoke to someone recently. I said, well, Jim, I hear you. When's all this coming to a head? And I said, maybe this winter or this spring, sooner than you think. And I based that on the last two super liquidity crises when the world almost completely collapsed, or maybe it did, were 1998, that was long-term capital management Russia, and 2008 during Lehman Brothers. But I remind people, Sunday, September 15, 2008, Lehman Brothers filed for bankruptcy electronically on a Sunday night. And that was like, we all know what happened next. But that crisis started in 2007. Remember August 9th, 2007, Jim Cramer and Aaron Burnett on CNBC, and he's yelling, they know nothing. They know. Well, he was right. They didn't know anything. They were idiots. I mean, meaning the Fed. But then Hank Paulson and the Super Civ and the Sovereign Wealth Fund bailout, and then Bear Stearns, Fannie Mae, Freddie Mac. And so there was a lot leading up to the Lehman Brothers, but it took a year. It took a year to go around. Same thing with long-term capital. It came to a head in September 1998. We were hours away from shutting every financial market in the world. We got the $4 billion in, stabilized the balance sheet, and life went on. But it was a really close call. But that started in June 1997 when Thailand broke the peg to the dollar, started to run on the bank in Thailand. It spread to Malaysia, Indonesia, South Korea. You always hear the expression, time to buy is when there's blood in the streets. Well, sadly, there was blood in the streets, real blood in Korea because people got killed. And then it went to Russia, then long-term capital. But my point is, everyone knows the acute stage, September 98 or September 2008, but it began a year earlier. So now everything we've just been talking about is already happening. It's been happening since last spring. So if you stick to this 1 year rule, and it's not a hard and fast scientific rule, but we've seen two cases where it took a year to come around. If that's your rule, and it started in March 2022, and there's good evidence for that, then kind of March 2023 is your D-Day. The number one question, because everyone's concerned about inflation, but there's a big backstory there. But I always say when it comes to your own money, everybody has a PhD in economics. You don't need Larry Summers to tell you what's going on with your budget and your ability to feed your family or keep a roof over your head. So people get inflation. It's one of the reasons it's so politically toxic is because it's unavoidable. You can't fudge it. You can't spin it. It's like, hey, if I used to fill up my Ford F-150 truck for $50 and now it's $125, A, you get it. It's right in your face. And B, that's $75 that you don't have to take your spouse out to dinner, buy a new jacket or whatever. So there's kind of demand destruction at the same time you're spending more money on the one thing you can't do without. So people get it. But then from there, the question I get the most is, hey, Jim, is this going to cause a recession? Are we going to have a recession? And as recently as a few months ago, I would say, yeah, I think so. You can see it coming late this year, early next year. Now I say, we're in a recession. I mean, it's not coming, we're in it. And there's data. I never make statements like that, Brian, without supporting it. We know that the standard definition of a recession is 2 consecutive quarters of declining GDP. There are a few more bells and whistles having to do with unemployment and a few other things, but that's the rule of thumb. So based on that, and based on the best available estimate for a second quarter, likely to be accurate, we're in a recession today. Now, it's not severe, but that's like saying I'm in bed with pneumonia, but I'm not dying. Well, okay, but we're in a recession right now. There's a lot of whistling past the graveyard. I mean, the stock market is still greatly overpriced. There's still the buy the dips mentality hasn't gone away. It's still there. You got people like Jim Cramer yelling, buy Netflix or whatever. There's institutional support. There's momentum trading. Of course, 95% of the trading is by robots. So you got to reverse engineer the 27-year-olds from Bangladesh who don't get out much. They're the ones really writing these algorithms. Brilliant engineers, but you'd have to show them around Wall Street. So all that's going on. So we haven't really seen the market collapse, stock market collapse that I would expect in association with a severe recession has not happened yet. This is just going to play out. It'll get worse as the year goes on.
All right, so you're expecting a major correction in stock markets on the back of a recession.
I'm not alone. I mean that is my expectation. I have my own models and I look at it closely. But if you listen to Michael Burry, Jeremy Grantham, Charlie Munger, these people have been around and they run hundreds of billions, and they're saying the same thing. So, so every now and then someone will throw some statistic at me, and I go, "How long is your time series?" And I go, "Oh, we took it back 5 years." I was like, talk to me if you've done it for 100 years, because that's a little more meaningful. But Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's a triple greatest bubble of all time times 3 in the sense that it's real estate, stocks, and other asset classes. So I do. That is my view, but it's shared by a number of other analysts.
And that would mean like S&P coming off another 20-30%?
Yes. And again, you have to remind people. 1929, the stock market fell 22% in 2 days. It wasn't one day. It was like 12% one day, 11% the next day. So 23% over 2 days. But that wasn't the crash. I mean, that was the beginning of the crash. This Dow Jones fell 82% from top to bottom. Now, it took 3 years. It bottomed in June 1932. Started in October 1929, so not quite 3 years. But that fell 82%. And that happens. So yeah, we're down. Nasdaq's down. Bounced back a little bit in recent days. Down close to 30%. Down the S&P down over 20%. We're in bear market territory. But that's just the beginning. That's not what a full bear market, market adjustment looks like in the face of the kind of recession that I expect.
Talk to me about inflation, because I was looking at some of the inflation numbers, and you have to go back to the 80s to see anything that's approaching double digit. I remember being just a kid hearing about double digit inflation. I could kind of remember the gas pumps, the lines at the gas. It's like a distant memory of me in the 70s. But how do you talk to, younger people these days about what inflation is or it means? Because I don't think people really grasp what it actually means to your savings or to the economy in even a medium term.
Well, that's exactly right, Brian. And if you, you're a little younger than I am, but I lived through it. I started my career in banking in 1976, and I remember my wife and I used to kid each other. She was in advertising, I was in banking, and the inflation was so bad, you'd get a raise every like 4 or 5 months, and you didn't have to ask. They would just give it to you because they knew that you were going to quit if they didn't keep up. So she would get a raise, and she was making more than I was at the time. So we'd go out to dinner, and then I would get a raise, and I was making more than she was. So we would just tease each other about that. But that's how it was. And the psychology was, if you needed a TV set or refrigerator, new car, whatever, you say, I better buy it now, because the price is going to be higher. If I wait a month or 2 months, the price is going to run away from me. So it had huge behavioral effects. Of course, gold was, going to the moon. There was a lot going on at the time. But Brian, you're right when you say we're putting up inflation numbers today that are the highest in 40 years. That is correct. But I remind people, the inflation in 1981 was the end of a 10-year period of inflation. That was when Volcker finally got it under control. But you go back to 70, between 77 and 81, so that 5-year period, the dollar lost 50% of its purchasing power, not 15, 50. So the question is this the beginning of an inflationary surge where it's going to get even worse and it is going to last 5 years? Or is it different than that? But keep that in mind, because the situation we're in today is very different from the 1970s, and I'll explain why. But I'll explain why right now, because in the 70s, it was triggered from the supply side with first the Arab oil embargo in 1973 as a result of the 1973 Arab-Israeli war, and then the price tripled, but it went from like $2 to to $6. Okay, but percentage terms, that's a huge jump, but it was still $6. And then it got to 12. And then in 1979, you had a second oil embargo because of Iran and the Ayatollah and the revolution and the hostages and all that. And then it went from kind of 12 to 20. So oil went up by a factor of 10 in the course of the late 70s because there's two different embargoes. So that's coming from the supply side. But what happened was the other source of inflation is on the demand side. So you have what's called cost push inflation. That's where supplies choked off, or there's an embargo, or there's a shortage, natural disaster, a lot of things. It's coming from the supply side, and demand is inelastic, so you just pay up or kind of do without. But the demand side is much more psychological. That's called demand pull inflation. That's when consumers behave the way I described, and as I say, I lived through the 70s, where hey, I better buy it today, I better buy it now. You're pulling all this demand forward and bidding up prices because you're worried that it's going to get even worse. So as that applies to today, we are starting with the cost push inflation, mainly the price of energy, but the price of food is a big factor. And of course, they're related. It's like, here's the energy, here's the food. Where do you think the food comes from? To get the food, you got to feed the pigs and cows. What do you feed them? You feed them corn. How do you get corn? Well, you grow it on a farm. You need nitrogen fertilizer. You need diesel in your tractors. You get the food, you got to put it in a truck to get it from point A to point B. That requires diesel. The higher the diesel price, the higher the cost of food because you're moving it by truck, et cetera. So these things, as I say, are linked. But food prices are going up substantially, and the two things you can't do without are gas in the car and food. So you have that cost push inflation. We're not quite at the stage where it's demand pull. We're not quite at the stage where individual consumers are behaving the way I described in the 1970s, saying, "Hey, better spend the money fast because it's losing value." The thing about the supply chain, I did all the research for the book. You say, well, okay, I got a loaf of bread, but there's no bread on the shelf. Where's the bread? Well, all right. Well, for the bread, you need a baker, right? Okay. So, but you also need a truck driver to take it from the bakery to the shelf. You also need a wrapper. You got to put some plastic or paper around it or something. Well, the baker, he needs an oven, right? Where's the oven coming from? What about the electricity to power the oven? You need some ingredients. Where's the wheat? Well, the wheat doesn't come from the wheat field. It goes to a mill first and gets ground up into flour and all that. But the mill gets it from a farmer. Where's the farmer get it? Well, he needs nitrogen, fertilizer to grow the field. He needs a tractor and diesel fuel to plow the wheat, et cetera. So the point is, you can segment a supply chain and say, well, you got to get from the bakery to the store. Yeah, that's valid. But every step along the way, first of all, the entire what's called the extended supply chain is much, much longer than people realize, number one.
Correct.
Number two, every spot on that supply chain has its own supply chain of inputs and outputs so that they can hold up their end. And that's just all for a loaf of bread. So the more you get into it, and again, you study this, Robert, so you're familiar with this. The way I put it in the book, the supply chain is not part of the economy. The supply chain is the economy. They're so broad, so extensive, and so many moving parts that you can model it theoretically, and there's some math that you can apply, but nobody can comprehend it all. The idea that you can sit there and direct it, which they seem to be trying to do in communist China, good luck with that. You can't actually do it. All you can do, you can facilitate it. You can get out of the way sometimes. You can stop doing stupid things, which the government is very good at, but you can't actually direct it because it's far too complex. So that's the first thing. And then, in terms of the impact on the economy, it links very quickly to the monetary economy. We can talk about that as well. We have inflation. Everyone sees it. You got a Ford F-150 pickup truck, and it used to be $75 for a tank of gas. Now it's $150. Well, the demand for gasoline in that situation is what they call inelastic, which means you got to buy it no matter what the price is. You don't like paying the higher price. You see it. You see inflation at the gas pump. You got to buy it because you got a business to run or errands to do or whatever the case may be. But what it means is that in that example, that extra $75 to fill up your tank twice a week, let's say, so $150, that comes out of something else. You're not going out for dinner. You're not buying a new dress or a new suit or a sporting event or a concert or whatever it may be. So there's demand destruction. It may not be at the gas pump, but it's in everywhere else in the economy.
Correct.
So you get into these ripple effects. So the supply chain dysfunction, which in my example shows up in the form of higher gasoline prices, then ripples throughout the entire economy. Right. So the impact is enormous. Eastern Europe, East Germany, parts of Central Europe during the Cold War, during the 1950s, even the Soviet Union, the shelves were bare. You would, if you thought there was meat coming, later in the day, you would queue up for hours just to get a cut of meat. Third world countries, I've been to many of them, traveled extensively throughout Africa, South Asia, India, elsewhere. And you see that all the time, where they just don't have things. We're not used to seeing that in the United States or in Western Europe or Germany, France, but we are now. And it's not that you go into a supermarket and every shelf is bare. That was the East German model. But you'll say, well, I'm here to get diapers, or, I like hot salsa, or, loaf, whatever it may be. And then that section of the shelf is fair. It's like, oh, no hot sauce this week, or no, a certain kind of vegetable this week, et cetera. And then what happens is interesting, because you go once, the shelf's empty. You go twice, the shelf's empty. You go the third time, and they just got a case, right? But if I normally buy 2 jars, I'll buy the whole shelf. I'm like, hey, I'm buying 10 because, I don't know when it's coming in again. I want the Celeste. So that's hoarding. You can call it hoarding if you want to be a little pejorative about it. But what I'm doing is I'm creating my own safety stock, my own inventory in my own kitchen, because I can't count on the supermarket. Well, what does that do to the next person who's looking for the hot sauce? They don't find any. So it feeds on itself, and it just gets worse. But to your point, Robert, it's a very powerful point. I say supply chains are not new. This Bronze Age shipwreck I was talking about, it did a coastwise trade in the Mediterranean counterclockwise, because the northern coast, the European coast, the winds blew, the easterly winds, and the southern coast, the African coast, were westerly winds. So it would make a big circle. But when they explored the shipwreck, underwater archaeology, so they found amber, which comes from the Baltic Sea. They found gold, which comes from Sudan. They found swords, which had been made in present-day Syria, Phoenicia at the time, but present-day Syria. They found olive oil, which, comes from Italy. The boat itself is made of Lebanese cedar, which, of course, comes from Lebanon. And there was a carving of Queen Nefertiti of Egypt. She was she was the queen at the time. And so if you say, okay, well, let's just plot that out. Where's this stuff coming from? So you go from the Baltic Sea, or, almost to, not quite to the Arctic Circle, down to southern Sudan, almost to the equator, as far east as present-day Iran, Persia, and as far west as Spain. That's 5 million square miles. So, and that was all on one vessel, because they were picking stuff up and dropping stuff off. It was coastwise commerce. So that's a huge supply chain, 5 million square miles in 20 different present-day countries. So they had the supply chain then. So what's new about the supply chain? And what's new, and this really started in 1989, is what I call supply chain science. That it became an academic subject. There are a lot of colleges, you get a major in supply chain studies. But it was a combination of increased computing power, new algorithms, artificial intelligence, and then new technology. So we got extended supply chains. So it was really the scientific aspect of it, the academic aspect of it, that transformed it. And it developed into what I call supply chain 1.0. Which is 1989 to 2019. So that was a 30-year stretch. That has now collapsed. We still have stuff, but we're in a very muddling phase. We're going to have supply chain 2.0, the new supply chain. I talk about that in the book and what that's going to look like. But that's going to take 5 or 10 years to put together. I talked to an individual, supply chain, you get millions of people involved, but this was the guy who was probably the single individual most responsible for building the modern supply chain. And he said to me, Jim, you have to understand, it took us 30 years to build it. It took 3 years to blow it up, break it down. It's going to take 10 or 15 years to rebuild. This is not going to happen overnight. So we're in this in-between stage. But the thing that caused it to collapse, there were a number of things. Everyone looks at the war in Ukraine and Russian sanctions, and that made it worse. And then they look at the pandemic and the pandemic panic and the fascist public policy that came out of it. Well, that made it worse. But it really started, you can trace it back to the Trump tariffs in 2018, because I found some research on cargo shipments, because there are all these vessels, again, you know this from your experience, Robert, oil tankers, dry bulk carriers, other kinds of, container cargo ships, et cetera. We know where they all are, they all have GPS, unless you're a couple pirates here and there, but basically we know where they're leaving, where they're going, what they have. It's all publicly available. And this one researcher tracked it, and she could show the breakdown beginning in 2018 with the Trump tariffs. Let me just give you a really concrete example. So 2018, Trump puts tariffs on China on appliances and solar panels. Korea makes some, but it was mostly coming from China. It was really targeted at China. So what did China do? Well, China, U.S. and Brazil are the two biggest producers of soybeans. China is the biggest importer of soybeans because they need the protein and they don't have that much. And so China was buying their soybeans from the U.S. because they're like, hey, this is one way to kind of balance trade with the U.S. The deficit won't be quite so big because we'll buy their soybeans. Well, when Trump throws the tariffs on China, China says, we're buying our soybeans from Brazil. And they shifted all those purchase orders to Brazil. Well, that's not a phone call. I mean, you got to reroute vessels. You got to expand port capacity. Right. You got to get transportation lanes from the farmers to the ports, et cetera. And the people who do that, the real people, real companies, they don't want a 6-month deal. They want a 5-year deal. So that was all done, but you've now scrambled vessels all over the world, changed, port entry and embarkation, et cetera, on like a 5-year basis. And so they're now, China's getting their soybeans from Brazil. What's the U.S. doing with all the soybeans? Well, we looked around and said, well, the Netherlands needs them. So we're sending them to the Netherlands. Well, again, you got to scramble vessels. You're not going through the Panama Canal anymore. You're coming out of the port of Houston, et cetera. So it's a concrete example of how, the eggheads sit in Washington and say, throw tariffs on the Chinese. But now you're scrambling global trade. That has, again, as I mentioned, taken 30 years to build. And the same thing's going on with semiconductor sanctions. And again, COVID made it worse, pandemic made it worse, and Ukraine made it worse. So we are where we are. But that's really the point. It's a complex dynamic system. You tweak one little bit and then it collapses over there. And everyone said, how did that happen? Well, the answer is that's how it happens.